This is the Traders Exclusive Live Trader Showcase for March 2024. This is a quarterly event where we feature expert traders to bring you training and insights from 20 different expert traders. So please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. So I want to thank you all for being with us again. I'd like to introduce Jacquie Munro, who writes Jacquie's Post for the Mad Hedge Fund Trader. Thanks for joining us, Jacquie.
Hello, everybody. Thank you for joining me today. I'm broadcasting from Gold Coast, Queensland, Australia. Beautiful Gold Coast weather. We've been having fabulous 28-degree days, just perfect autumn weather. Thank you, Sherry and the team at Traders Exclusive for inviting me to speak at this seminar. For these webinars. It's great to be here, and I'm looking forward to sharing my webinar with you all. So without further ado, I will stop my video and share my screen, and we can start. Okay, I'm sure everybody can see that. Just let me know if you can't. So I'm called Mad Hedge Jackie's Post, usually Jackie's Post, and I'm a product under John Thomas's heading the Mad Hedge Fund Trader. So I will be talking today about how I make money in the markets and how you can make money in the markets. I will also be talking about gold and silver and their potential to rally hugely in the next 6 to 8 years, for the next 6 to 8 years, and also talking a little bit about the commodities market as we move into a global economic recovery. Specifically, will start to happen as all the countries around the world start to reduce their interest rates. And also, I've just seen today that Switzerland has taken the first step of all the countries around the world in lowering their interest rates. So that's very interesting. So how did I make money in the markets? I used multiple vehicles. So instead of just buying stocks and waiting for them to go up, I also used options. I also used the Forex market. I also bought ETFs, and I also used CFDs, which are contracts for difference. I did a lot of study about mindset and my psychology, and I also studied how the markets move. So that was a big step in the right direction for me, because understanding how the markets move gives you a really big leap forward, as opposed to many other people that react to the markets. I was ready to place my trades no matter what the market was doing. So determining the best option to use in different types of markets, I had a plan. So I was very disciplined. I was consistent. I did not overtrade, although I did so when I was very early on in learning how to trade. I knew how to add a position or roll forward. I was very patient and resilient. So you definitely need these two things if you're going to have any longevity in trading the markets. I took advantage of volatility and these two things, which hardly anybody focuses on at all when they're trying to teach people how to trade: exercise and real food. So you definitely need to exercise if you're going to trade, and I'll go into that a bit later. And real food, I mean, you are what you eat. So if you eat rubbish, well, then you'll have rubbish output, basically. So what does using multiple vehicles mean? So let's say you're going to trade the euro, and the euro is in a bull market and it is going up against the US dollar. So I buy a position in the ETF, EURO. I pyramid into euro positions in the Forex market. So I'm actually accumulating positions at different levels. I buy a call option or a spread or leaps, and I'll explain that later, which will expire at future dates. And then I pyramid out of these positions at different times. So in the tech sector, it is another example. Say I wanted to buy Micron Technology. I could buy a small parcel in this stock. I could purchase options. I could also purchase a CFD. I could also purchase ROM, and that's the technology ETF. So by doing so, by putting your finger in all sorts of pies and in vehicles here, you are effectively multiplying your returns in a massive way by incorporating various vehicles. So you're spreading the risk. You're not just purchasing options and putting all your risk into one vehicle. You're spreading the risk. So here in 1996, I bought installment receipts for Commonwealth Bank. The number was 300, and you paid it in 2 separate parcels. So the total value was $6. In 1996, I paid $4.45, and I paid the remainder of the $6 in 1997. And that gave me 300 shares. And in 2009, I received a share purchase plan after the 2008 crash to purchase more Commonwealth Bank shares. Excuse me. And there was no brokerage to be paid. So I sent a check for $25,000 on the 10th of the 3rd, 2009, to purchase these shares. And as I had quite a large portfolio, I received different share purchase plans for my different stocks that I had at the time, like BHP and Rio Tinto. So how can you make money in the markets? You can use more than one vehicle at a time, which is what I've just showed you. You can use options, ETFs, CFDs, stocks, Forex, or futures. So the best option strategies to use, if you are just going to use options, I would say would be good bull call debit spreads and bear put debit spreads and leaps. So these would be my favorite strategies to use in the options market. Types of debit spreads include bull call spread, bear put spread, bull put spread, and bear call spread. Okay. Debit spreads, they have 2 legs. So you buy a call option and you sell a call option at a higher strike. The maximum loss is limited to the initial debit paid. The maximum profit is the difference between the 2 strike prices less the initial outlay, so the debit paid to establish the spread. So you know when you put this trade on, what you can lose. So here is a picture of bull call debit spread. So this is the lower strike price here. This is the break-even point here. And the break-even point is worked out by adding the premium paid to the long call option. And this is the short call strike price, the one you sold at the higher strike level. So you profit when the stock reaches your short call or over that short call. And of course, if it's lower, then it will be classed as a loss. Advantages of debit spreads: there is limited risk, higher probability of profit, and it's a lower cost because you, as well as buying your call, you sell a call, and that brings in income, which lowers the cost. And then there's flexibility with it as well, because you can change the strike prices, you can change the expiration date or month, so you can roll it forward. If it looks like it's losing, it's a losing trade, you can roll it forward and change the strikes or the date of expiration. Exit strategies: you can set a target profit. You can use stop loss orders, which I strongly recommend. You can roll over options, as I've just been spoken about, and you can take profits partially. So you can have two levels of take profits. So you can reach one profit target and take half off, and then set another profit target and take your other half off. So basically you can know where you're going and know where you're getting out before you can even get in to the trade. So when you place a trade, you can set your stop loss, you can set your profit target, so it takes all the emotion out of that trade. So here, Schwager says there is no single market secret to discover. There's no secret sauce, no single correct way to trade the markets. Those seeking the one true answer to the markets haven't even gotten as far as asking the right question, let alone getting the right answer. Identifying optimal entry points. You have to use technical analysis to know when to enter a trade, to know when to exit a trade. You have to use fundamental analysis to know what's going on in the markets in general, in that sector within which you're trading, and in the stock which you're trading. Understand market sentiment and the time horizon. What are LEAPs? So they're long-term equity anticipation securities. They're actually option contracts with expiration dates that are out a year or longer. So why do we use LEAPs? Investors use them to benefit from potential rises in a specific stock while using less capital than purchasing shares with cash up front. So we all know that buying shares can cost a lot of money. I mean, one share can be $800 or more. So imagine if you were, for example, buying NVIDIA, which are now over $900. So one share is $900. So purchasing a LEAP over NVIDIA is much cheaper than buying the shares. But LEAPs cost more than traditional options because they have more time to expiration. But they're certainly cheaper than buying some stocks, which are hugely expensive. So here is a picture of the COVID crash that we had in March 2020. And here, and you'll notice that the market dropped very, very rapidly and then bounced back. It's sort of like pulling a rubber band and then letting it go, bounced back very rapidly. So you can hear, so this is an example of where you could put LEAPs on and put them on with an expiration of a year out and 2 years out. And then profit very handsomely, which many people did. They put LEAPs on down here and made an absolute fortune. So some people just bought a single option, so just bought the option and paid up front. Some people did a spread, so it didn't cost them as much, but both strategies made a lot of money. So making money in the markets. So we now turn to psychology, and psychology is about 90% of trading. So to be successful, you have to have a very good mindset. There are 6 basics of stock trading psychology. Managing your emotions. So fear and greed is what you're up against. Traders need to be aware of their emotional state and learn to control them. So basically, you need to check in with yourself every so often. It requires self-awareness, emotional regulation, and psychological tools. Maintaining discipline. So for this, you need a trading plan and a set of rules and guidelines. You need to manage your risk and impulsive trading decisions. Developing a trading plan makes you stay disciplined. It manages risks and you stay focused on your goals with a trading plan. Cultivating a long-term perspective. Here, by looking ahead and by looking with a long-term view, you're able to ride out short-term market fluctuations by focusing on trading goals over the long term. So focused on the next 1,000 trades that you're going to do instead of just the one that's right in front of you now. And that actually builds discipline and confidence. And overcoming biases. We all bring past experiences, beliefs, cultural norms to our trading. So you have to recognize them. Traders can work through them and make rational decisions, but as long as you understand where you're coming from and why you are making the decisions you're making, and understanding market behavior. That's a big thing. I mean, I would advise people that are fairly new to the market to sit and watch the market, especially through when there's news like Fed statements, non-farm payrolls, earnings, and just watch the market and see how it behaves. I mean, it's basically us controlling the behavior of the market through our fear and greed. So we're moving the market with our emotions. So why do we mess it up? Overconfidence, loss aversion, and confirmation bias. So overconfidence, we take unnecessary risks, making unrealistic assumptions about the markets. We can lead to lack of discipline and failure to follow a trading plan. So we're so confident that we just throw the trading plan out the window. What to do about this? You need to be realistic about your abilities, seek advice and guidance through other traders. And that's why I've always recommended a buddy system. So if you're concerned about your trading, just ring somebody up and have a chat with them and say, you know, what do you think about this? Or what do you think? I've put this trade on. Do you think it's a good idea? So you're getting another view from another person. Loss aversion. This is a bias that causes traders to hold on to losing positions for too long. And I think we have all done this. I think we're all guilty of this, hoping that the markets will eventually turn in their favor, which of course can lead to significant losses and a lack of discipline in time management. So what to do about this? Be willing to cut your losses. There's always going to be another trade. Stop loss orders must be put in place, and this will limit losses. As I say, put your stop loss in, put your take profit in when you enter the trade. This takes all the emotion out of trading. Confirmation bias. The bias can lead traders to seek out information that supports their existing beliefs and ignore information that contradicts those beliefs. What to do about this? Consider all available information. Do not be influenced by preconceived notions. So again, it's about awareness. Recognizing biases and steps to take. Be realistic about your abilities. So if you need to ring a fellow trader up, do so and discuss your trade with that person. Set realistic goals. Be disciplined in risk management and seek advice from other traders. Mindset. Mindset is everything. Resilience, patience, focus, exercise, and food. Okay, so resilience. We need resilience if we are to trade for the long term. Do you want to have longevity as a trader? You're going to need resilience because not every trade is going to go your way. You are going to have losing trades and you have to be able to bounce back from those losses. Patience. You will absolutely need patience. You need to wait for the market to come to you, and most of trading is spent waiting for the market to set up for you to put the trade on. Focus. Focus comes from concentration and discipline and trading plans and managing your emotions. Exercise. You need exercise if you want to trade successfully. And I will go into that in the next slide. And food, good food helps with the ability to trade well. Benefits of exercise for the trader. Keeps the mind sharp. For traders, this is essential. You have improved mood, concentration, incorrect spelling there, improved. Better mood, stress reduction, releases hormones like dopamine and serotonin, which help improve focus and concentration, aids impulse control and planning, and fear management. So we all know when we go for a run or go for a walk or a hike or a swim or do some weight training or yoga, we always feel better after we do that. And it will give you, make you a much better trader, able with clarity in mind and improved concentration. So here I was talking about waiting and patience. Okay, so trading is 10% buying, 10% selling, and 80% waiting. This is what I talk about patience. You can't underestimate patience. The stock market is a device for transferring money from the impatient to the patient. This is what Warren Buffett says. So if most traders would learn to sit on their hands 50% of the time, they would make a lot more money. Okay, so this is all wrapped up with patience and waiting. And this is what a lot of trading is about, waiting for the setup. Okay, so this is a quote from a CEO that you all know. I'm just going to read it and then I'll tell you who the CEO is. Often people with very high expectations have very low resilience because they are not accustomed to or prepared for failure. Unfortunately, resilience matters in success. I don't know how to teach it to you, except for I hope suffering happens to you. So this is a CEO of a major company. So he's basically saying that suffering creates character in a person. And that degree of character, which creates resilience, will ensure success. So the CEO that said this is Jensen Huang, the CEO of NVIDIA. Now, he has done incredibly well and he has suffered enormously in his life. So he speaks from experience. Your responses. So whether you win, lose, or draw, your response should be the same when you trade. You control your behavior. Make sure the action of trading and investing does not control you. The markets don't care what is happening in your life. So I always find it's a really great idea to keep a book of your trades and investments and handwrite it. So with the date, the trade, the investment, whether you win or lost, and why it didn't work or why it did work, and the profit and loss. And then over the years, you can look through it and look back at how you did and how you've improved. I always think that's a great idea. This is what I learned to say to myself when I was starting trading, and I still do say to myself this statement, that was good because. Now, why I say that is because you're going to win and you're going to lose in trading. So by losing, by losing, you are learning something from your loss. Okay, so that is good if you learn something from your loss. If you profit, you understand and reinforce what you did well. So that is good as well. So we have to interpret that losing is not bad, but it's part of doing business in the markets. It's a lesson, so you need to store it. The more lessons, the better you will become. So basically, it's all good. So this is basically your rules, your philosophy, how you're going to approach the market. So are you going to trade every day? What time of day are you going to trade? Your strategies you're going to use, the sector you're going to trade. Are you going to trade the whole market or just one sector? Are you going to trade one stock or many stocks? What entry? Where are you going to enter the market? In what time period are you going to use? The 5-minute period, the 15-minute period, 30-minute period? You're going to know when to exit when you place the trade. So you've got your entry, you've got your stop loss, and you've got your take profit level all set up when you enter the trade. How do you exit? Do you take half off and let the other half run to a secondary exit level, or do you take all your profits? Stop loss, where do you place it? Just above resistance level or below support level? The size of your trade. You can start small and then accumulate over time and average in, which is what I teach my people to do and what I've always done. Be careful not to get cocky and add too many trades. You must manage your trades. When not to place trades and why? Okay, so earnings. I mean, the market can interpret even good earnings and make the stock sell off, or it can go up. So it can go either way. It's just how the market interprets those earnings. Ex-dividend dates, the stock usually goes down. In news, Fed meetings, there can be huge volatility. So I wouldn't suggest you start trading and put on a trade when this is happening. And non-farm payrolls can be also very volatile. Reading the charts. So we have to be able to do technical analysis and read the charts in order to enter a trade and take a trade off. So we have to recognize patterns, know about moving averages, MACD, moving average convergence divergence, the RSI, relative strength index. It's a good idea to be able to recognize candlesticks, and we need to know about time periods, of which time period we're going to use to look at the market as a whole, and to know when to enter and exit our trade. So you need to trade with the chart, not with your heart. So the best chart patterns to know are head and shoulders, double top, double bottom, rounded bottom, cup and handle, wedges, pennant or flags, ascending and descending triangle, and symmetrical triangle. They're really good to have in your box of tricks and knowledge, because they can tell you, you can set your trades up according to what chart patterns you see. So this is a head and shoulders. Here's the head, the shoulder, and the shoulder. And this is the neckline. You can draw under here. So most people would be putting a limit order here for the to take that trade in as soon as this broke down here. Double top, as we can see here and here. And this is the neckline. And this is what happens when it breaks the neckline. The potential is to go in a bearish direction here. A flag pattern. We notice how the flag, when we have a flag pattern, the price continues up in the direction of the original trend when it breaks out of the flag pattern. So here you could put an entry order here, and as soon as it breaks out, it takes your trade automatically. And really, your take profit entry order is basically the length of the flagpole here. So you just measure that and measure the distance up to here, and you put your take profit order there. Cup and handle. This is the cup and the handle. And we usually get a breakout here, and we get a bullish movement here. Triple top, 2 point make a third. We have a triple top here. And the neckline here, once it breaks this, a very good break here of the neckline, you can put a trade here, and it will take it and go to this measured target. So the distance between the neckline and the tops here is the distance between the trade entry and the break of the neckline and the take profit target here. So that's how you know where to put your profit target. And I could really do just a whole webinar and a whole course on 2 points makes a third, teaching this and how to recognize this in charts. Candlesticks. Great to be able to recognize candlesticks, because it tells you which candlesticks will have potential to have a bearish move, or which ones have potential to follow on with a bullish direction. So if you see a hanging man or a bearish engulfing candle or a spinning top, usually after this candle there is a bearish move, so the stock can go down. If you see an inverse hammer and a hammer or a bullish engulfing candle, the potential is for the stock to go up. If you see a doji or a spinning top, you can also see dojis at the bottom of a range, and they can also signify changes of direction, or you can see them at the top of a range, and they could also signify a top in that stock or the market even. So this candle is called a hanging man, and it's pretty self-explanatory. This is the head and this is the body. So that's why it's called hanging man. This is an inverted hanging man. So when you see these in the chart in a stock, potential is for a down move. These candlesticks are called hammer. That's a hammer. That's an inverted hammer. When you see this at the bottom of the range, the potential is for a rise, a bull move in the market or in a stock. So the reason that most traders lose is that they don't have the necessary knowledge, conditioning, skill, and experience to get in and out when the order flow is favorable. They have to buy when fear is highest at the bottom of a move. So, for example, you needed to buy at the bottom of the March 2020 move when we had that big drop from COVID. And sell when greed is highest at the top of a move. So in 2000, when we had the tech bubble, you need to sell then. In 2008, when everybody was buying, you need to sell at the top of those moves, top of those markets. This goes against, of course, rational thinking. Smart money plays on those fears and greed of traders by using their own hardwired thinking against them. So smart money is trading against the herd, and they always make a profit as a percentage of total traders in the market. The few winners are the professionals who trade in opposition to the herd. So what is trading about? Trading is all about patience, emotions, and risk management. Don't expect to be right in every trade. Learn to accept losses too. So now we're going to have a look at the market, and we're going to go into silver and gold and the metals and the commodities. So my SBS target, S&P target for the short term is 5,221. My long-term target for the year is around 5,750. But we could get, some analysts are saying we could get to 6,000. So precious metals. There's been a slight fall in rates, and expectations for rate cuts have sent metals on a bullish move. And the Fed just confirmed yesterday that we will get 3 rate cuts this year. And we may even get more than that. Stocks have bounced in anticipation of those rate cuts, and also stocks in the gold and silver sector have also bounced, and they're starting to play catch up. There's a shortage in silver developing. Demand is up 16% in 2023 to 1.2 million ounces. Gold is headed for 3,000 by 2025. But of course, will show volatility on the way to its target. Collapsing interest rates will be the story for 2024, and Russia and China are still stockpiling gold to avoid international sanctions. So this is the daily gold chart, and this was before the breakout we had a couple of weeks ago. So we had a symmetrical triangle, and now we have gold. It's actually up here just over 2,200. So the initial target I have is 2,210, and I'd say we could actually reach that target this week. So this is the daily gold chart after last week's breakout, and you can see we're up here. This one's showing we're at 2,178. This is the monthly gold chart, and here we can see very clearly a head, shoulder, shoulder, and this is on the monthly chart. This is the peaks we've had with COVID, with Ukraine invasion, and the Middle East crisis. So we've had those 3 spikes there, and now we are we've broken out up here above this resistance level. And this breakout will take us up, to many thousands. Some people are predicting 5,000 in gold over the next few years. So back in 2008, we had central bankers around the world launching QE. And that increased the supply of money and where they lowered interest rates. So with cheap and abundant money, QE worked, and it created a bull market in everything except for precious metals. As a result, stock markets, consumer lending, and property values surged. And then the consequence of that, we now have huge debt. So in 2023, 2024, the share of debt for a child born is 78,000 plus. By 2050, at the age of 30, that child will have 226,000 plus as a share of debt in America. So basically the debt is a ticking time bomb. By 2050, debt is projected to reach 185% of gross domestic product. So from the Great Recession of 2008, debt in America has just exploded. And you can see the comparison here back to World War I, World War II, and the Great Depression in comparison. It's just a growing nightmare. And something will have to be done about it. The prices of gold and silver do not reflect a world with cheap and easy money, but their time to shine is here. And this is one of the reasons that gold and silver will rise, because they'll be a safe haven away from potential volatility from, just one thing, the debt in the world, and more specifically in America. Gold and silver are money, JP Morgan says. Everything else is credit. So factors influencing a higher silver price in the future: there is insufficient investment in mining production. Mine closures and increasing operating costs are showing up in the market prices. Major mines forecasting reduction in silver supply. And new technologies will mean more demand for silver. And also there's just general investment. So this is the chart of silver over the last 12 years. And if we go back and we think about those chart patterns I showed you, what pattern can you see here? This is a cup and handle pattern. So as soon as the silver price breaks out here, we will see it start to rally up in the next few years. And the first target is around $37, according to some analysts, and the way I have looked at it too. That's around my first target. So silver 10-year price forecast in a commodity bull market. So these are the long-term forecasts by some analysts. 2024, $70. 2025, 120, 26, 230, 2028, 1,350. So, the direction is a huge bullish move over, into the early 2030s. Same here, JP Morgan for 2024 has $30, predicted $30. Commerce Bank, $30. Citigroup, $30. Robert Kiyosaki has gone out on a limb and saying 500 by the end of 2024. Investing Haven is saying 34.70 to 48 in 2024. So the declining silver production will increase the value of silver in the long term. So this is another reason why silver will keep increasing in price. And silver is not just a precious metal, it's also extremely useful. So it stands apart from gold, really, as it has industrial uses that account for more than 56% of its annual consumption. So here we show the breakdown of how and where it's used. So in solar, it's nearly 14%. Industrial, it's nearly 50%. Bullion, nearly 27%. Jewelry, over 17%. Silverware, nearly 8%. And photography, nearly 2.5%. So in renewable energy, demand for silver will just keep growing. The future of silver in growing sectors, applications in tech and batteries will keep driving demand higher. So how do we buy silver? You can buy silver coins and silver bars. And you can also store that in a bank vault. You can also buy ETFs, the iShares Silver Trust, or the Aberdeen Physical Silver Shares ETF, SILV. And some people that are very experienced will buy futures contracts. Between 1997 and January 98, Buffett's company bought 129 million ounces of silver, much of which was priced under $5. So Buffett is a buy and hold person with Berkshire Hathaway. So this is what he does. He buys and he holds. This is a monthly silver chart from 2004 until 2024. You can see here the spike in 2008 and then the decline of the metal, while everything else in property was going up. But what about gold? Why should we have gold in 2024? Well, central banks have been buying up gold, more than a net 800 tons, actually. And gold in the first 3 quarters of 2023, and they're actually buying more in 2024, and that this will keep happening, actually, as we go on through 2025. And there's been a lot of inflows into ETFs as well. So why is gold going up? Well, it's protection against volatility. And as I said, I was talking about the debt in the world. So it becomes a store of value and a safe haven against what's happening with debt in the world. Protection against volatility, against high inflation. You buy it against as a safe haven for economic and geopolitical uncertainties, which we certainly have in the world at the moment with the hotspots in the Middle East and Ukraine. There are imminent rate cuts coming, so gold and silver will rally as the rates come down, but they're already rallying now in anticipation of that. And gold and silver will continue to rally as the US dollar falls, and it will start to fall sometime in 2024. The Fed cutting cycle and falling US real yields will once again become the mono driver behind gold's breakout rally later in 2024. So says Gregory Shearer, the head of base and precious metals strategy at JP Morgan. This is central bank holdings of various countries around the world. You can see the US here at 68% and China at the other end at 4%, although I don't think that's a real reflection of China at the moment. I think their holdings are increasing at quite a rapid rate. So where's gold headed? These are some price forecasts here, but I think we've already in 2024 exceeded the fourth quarter price forecast, which was 2,175. The first quarter for 2025 is 2,225. Fourth quarter is 2,275. Here, the gold price prediction from other analysts is 3,000 for 24, 3,500 for 25. And then, you go down to 2030 and it's over 9,000. And then for 2032, it's nearly 11,000. So, the moves are going to be enormous. So, the thing is to get positioned into your stocks, your ETFs, buy some options, buy some leaps. This is the monthly gold chart from 2004 to 2024. Here you can see again the 2008 peak here, and then it fell away. You can see here the COVID spike, Ukraine invasion spike, and the Middle East crisis spike here. And then it has broken above this resistance level and is now broken out to the upside. So now we move on to some stocks here. This is GLD, and it's been rallying very strongly. So wait for a pullback to enter a position. Don't enter on the push. Wait for a pullback. And if you start recognizing patterns here, you will see this is an inverted head and shoulders. So this is the head, shoulder, shoulder, and we get an upside move. Here's Barrick Gold, GOLD. So again, I would recommend you buy on dips. And if you get a very good dip here, get into a leap 1 year out. And of course, here, once again, we have the inverted head and shoulder pattern. And we also have actually a double bottom here. So very powerful patterns. Wheaton Precious Metals, again, double bottom here. And I've been recommending to all my subscribers to get in on these lows and accumulate positions as the stock falls. Silver, SLV, once again, we can see these patterns and recognize the pattern setup, inverted head and shoulders here, and which will eventually break out to the upside. GDX, similar patterns, almost double bottom here, and you can see the big white candle here, which is be interpreted as a green candle, like a bullish engulfing candle, covering this red candle. So meaning that the next candle will be a bullish move. Energy and commodities, and I'm recommending people get into energy and commodity stocks as we will eventually move into a global economic recovery, and there will be strong moves up in these sectors for several years to come. So after 3 years of volatility, commodity prices are set to stabilize in 24. Adverse weather conditions, escalating geopolitical tensions, and soaring shipping costs are among the risks to watch. Energy and oil are moving as one and have been quietly moving up. So I recommended my people go into ExxonMobil. I recommended leaps for them to go into, and I also recommended them to buy the stock. Caterpillar and Freeport-McMoRan are great plays to also be in for the long term. This is Cameco. I recommend you buy on dips here. It's a long-term play. US government is a major buyer of uranium and is also restarting plutonium production for the first time in 20 years. So this is a great long-term play. Occidental Petroleum, Buffett's a big buyer of this stock, and it's a great stock to be in, but buy on pullbacks. This is ExxonMobil, and I got everybody into this, all my subscribers, at around $100 on leaps, and I told them also to buy the stock if they didn't want to do the leaps. How do I use my profits, or how have I used my profits? I have educated my son for 5 years at a UK boarding school. I travel a lot. I've invested in myself through courses and training to create multiple streams of income. And I've sent my son to language camps in Europe. This is Ludgrove. This is the prep school he went to in Wokingham in Berkshire. These were the fees I paid, £9,364.59. There were 3 terms, and that cost me about 60,000 Australian dollars a year. These are some of the holiday snaps we have. This was at Lake Tahoe, and it was in the fall. You still had the snow on the mountains in the background, but it was a beautiful day, and we had a beautiful holiday there a few years ago. This is in Switzerland, where I went hiking. This is in London, beside the Thames. I was having lunch and checking my trades. This is Solomon Islands, showing my son how the other half live. This is my Gold Coast. This is where I live, beautiful beaches. And this was in North Queensland, up near Mackay, when I did a road trip. So about me, I've worked in the mental health and drug and alcohol unit for 10 years in Toowoomba Base Hospital. I studied all the time I was there, and I finished with a Master of Business Administration. I'm a qualified TEFLA teacher, which is teaching English to teaching English to foreigners and adults. I've done that part-time for 30 years, and I still do a bit of it now. I've run my own fund. I've worked for the Mad Hedge Fund Trader since 2010. And I also had a stint in the outback of Australia as a Jillaroo, or cowgirl, as you know it, in the US. Warren Buffett's investing tips. These are my favorite. When you buy a stock, plan to hold it forever. Most news is noise, not news, and the best moves are usually boring. So the investing space will look very different in the future. You know, will you have all the updates that you need, and will you be able to confidently identify winners from losers? I mean, that's the question on everybody's lips. They want to know which stocks to invest in, which ones are going to do well in the future. The truth is that most people can't trade. Only 1% last really after a year. 40% trade for only a month. Really 90% lose their whole balance they started with after 90 days. So the stock market is about transferring money from the impatient to the patient, as I've said. And the markets are unforgiving, and emotional trading always results in losses. So the market is about time in the market, not timing the market. So with an average annualized return of 12.7% over the past 90 years, you cannot argue with that. It's a great return. So could the S&P rally to 14,000? There have been 2 secular bull marks since 1929, with both generating returns of 2,300%. And we could have another result of 2,300% from the 2009 to 2032 or 2034. And the reason we could have this is because we're now going through basically another revolution, like the Industrial Revolution with AI and technology is increasing at such a rapid rate. And this is what could take the market up to this level. So, the technology will change health, finance, transport, agriculture, housing. It will change everything. Medicine, our health will be transformed. The way we get around will be transformed. The way we do business will be transformed. The way we live will be transformed, and the way we operate and feed ourselves with agriculture will be transformed. So it would not surprise me at all to see the market at 14,000 in the 2030s, the early 2030s. So how do you benefit from my product, Jacquie's Post? You get up-to-date information on the market, the economy, and geopolitical events, 3 newsletters a week. I explain and educate you about stock market terminology, reading the markets, understanding when to enter and exit the market, all the technical analysis. Thomas holds a webinar once every fortnight. I summarize the main points and send it out in a post. I give you trade ideas, details of a trade, and explanation of why the trade is a good idea. We've had several successes in the last year: McDonald's, DigitalOcean, Palo Alto Networks, and also these: Visa, Google, Johnson & Johnson, Amazon, Snowflake, and Arista Networks, all successful trades. I held a Zoom monthly meeting to bring subscribers together, educate and connect the community. You can ask any questions. I hold social events twice a year. This was Melbourne in January this year. Here's a testimonial very kindly from John Morrison, who is an accountant on the Gold Coast, basically saying I gave him much guided, successful trading and shut out the noise, and he highly recommends me for helping anyone, whether a beginner or advanced in trading. So you get 3 newsletters a week, a summary of John's webinar presentation, sent out once per fortnight. Trade ideas will be shared when the risk reward is in your favor. Monthly Zooms to educate, share ideas, experiences, and ask questions. Twice yearly social events in different parts of the world. So your price for today, $3.99 for 6 months with a special report about AI and a free trade alert. Limited places available. Click on the link in the chat box on the right. So can you guess what this chart is? Is it a buy or is it a sell? If you purchase my product, you will receive this trade alert on this stock directly to your inbox. So take a step and change your life. $3.99 for 6 months. Join our community. Have fun. Learn to trade the markets, how to make money and boost your income. And get to know fellow traders and exchange ideas with them. We always have great fun. So click on the link in the chat box on the right and join our community. Thank you so much for listening today. I really hope you got a lot out of my webinar. I hope you take the step and join me and my fellow my subscribers. Thank you, Sherry, and the team at Traders Exclusive for having me today, for inviting me to speak here. It's been a great pleasure to speak, and I hope I will be able to have the opportunity to return in some date in the future. So thank you, everybody, and wishing you